Corporate governance best practice. I'd like to start by talking about the role of the company secretary, because I always tell my clients and students that the company secretary is the board's corporate conscience. The company secretary is responsible for ensuring that board procedures are complied with, for advising the board on all corporate governance matters, and supporting the chair and helping the board and its committees to function efficiently. The company secretary, in conjunction with the chairman of the board, is responsible for ensuring that best practice is adopted, and in particular for ensuring that directors have all the information that they need to know, and at the limit of actually keeping the directors out of prison. The company secretary should report to the chair on all board governance matters. However, this does not preclude the company secretary from also reporting to the chief executive or other executive directors in relation to their executive management responsibilities. The remuneration of the company secretary should be determined by the remuneration committee. The company secretary should arrange for the company to provide the necessary resources for developing and updating its directors' knowledge and capabilities. It is the responsibility of the company secretary to ensure that directors, especially non-executive directors, have access to independent professional advice at the company's expense, where they judge it necessary to discharge their responsibilities as directors of the company. The chair and the company secretary should periodically review whether the board and the company's governance processes are fit for purpose, and consider any improvements or initiatives that could strengthen the governance of the company. The company secretary is in a unique position between the executive and the board, and well placed to take responsibility for concerns raised by the workforce about conduct, financial improprieties, or other matters. Let us start by looking at some global board governance norms and best practices as reported by Farriant Advisors. Director age limits. Most countries do not have a mandatory retirement age for directors. Companies determine whether to impose age limits, but there are some general guidelines, generally 70 or 75 years. Director attendance. Most countries require directors to attend a minimum percentage of board meetings per year. The most common guideline is 75%. Director diversity. Shareholders in many countries pushing for diverse boards and publish guiding principles. In some countries there are statutory requirements. For instance, in Belgium 33% minimum women on the board, France 40%, and Germany 40%, not necessarily on the board, but on the ballot for the board. Director elections. Annual elections. India, Norway, Switzerland, United States and UK require annual elections. Director tenure. Directors serving more than 10 years are generally viewed as no longer independent. In the UK, that is 9 years. Most countries focus on director evaluations and nomination processes to decide how long a director should serve. Director term limits. In most countries, these are determined by the companies. The most common limit is 1 year. In some countries it's mandatory, for example in France 3 to 4 years. Committee structure. Committee chairs to be independent. The UK Corporate Governance Code. The UK Corporate Governance Code was revised and published in July 2018 and applies to all companies with a premium listing to accounting periods beginning on or after the 1st of January 2019. The code is supported by the report Guidance on Board Effectiveness, which was also published in July 2018. The guidance is intended to stimulate thinking on how boards can carry out their actions and decisions when reporting on the application of the code's principles. Boards should also take into account the Financial Reporting Council's other reports, guidance on audit committees, and guidance on risk management, internal control, and related financial and business reporting. These reports are all available for free download at www.frc.org.uk. So let's look at guidance on board effectiveness. An effective board. An effective board defines the company's purpose, sets strategy, understands how value is created, and manages conflicts between short-term interests and long-term impacts of decisions. An effective board defines the company's purpose, sets strategy, understands how value is created, and manages conflicts between short-term interests and long-term impacts of decisions. Effective directors understand their duties both collectively and individually. They act in a manner consistent with their statutory duties, and they uphold the highest standards of integrity and support the chair in instilling the appropriate values, behaviours and culture in the boardroom and beyond. The board sets the framework of values within which the desired corporate culture can evolve and thrive. Ownership of the values will be stronger if a collaborative approach is taken. Defining values is a two-way process between the leadership and the workforce. Values are embedded at every level of the organisation. The board should be assured by management that it has effectively embedded the company's purpose and values in operational policies and practices. Incentives, rewards and promotion decisions should be aligned to value. The focus on culture needs to be continuous. The board is expected to assess and monitor culture for alignment with purpose and values. The first step is to identify and track core characteristics that are typical of a positive culture. Common attributes of a healthy culture are honesty, openness, respect, adaptability, reliability, recognition, acceptance of challenge, accountability, and a sense of shared purpose. Sources of culture insights: turnover and absenteeism rates, training data, recruitment, reward and promotion decisions, use of non-disclosure agreements, whistleblowing, grievance and speak-up data, and employee surveys. Sources of culture insights also include board interaction with senior management and workforce, health and safety data, including near misses, note that, promptness of payments to suppliers, and attitude to regulators, internal audit and employees, and finally, exit interviews. Decision making. Boards can minimise the risk of poor decisions by investing time in the design of their decision-making policies and processes. Boards include the contribution of committees, and boards obtain input from key stakeholders and expert opinions when necessary. Boards meet regularly to discharge their duties and allow adequate time for consideration of all issues falling within their remit. Ensuring there is a formal schedule of matters reserved for its decision will ensure the board's planning and provide clarity to all over where responsibility for decision-making lies. Factors known to distort judgment are conflicts of interest, emotional attachments, unconscious bias, and inappropriate reliance on previous experience and decisions. Some chairs favour a series of separate discussions for important decisions, covering steps like concept, proposal for discussion, and proposal for decision. An effective board will appreciate the importance of dialogue with shareholders, the workforce, and other key stakeholders. The chair has an important role in fostering constructive relations with major shareholders and in conveying their views to the board as a whole. Non-executive directors should take opportunities such as attendance at general and other meetings to understand the concerns of shareholders. And shareholders should be able to discharge their stewardship duties effectively at shareholder meetings and the annual general meeting. Boards may want to consider additional ways to engage with smaller shareholders, for example via meetings of group engagement such as shareholder roundtables or webinars. The chairs of the audit, remuneration and nomination committees should be available to answer questions at the AGM. The company's approach to stakeholder engagement will be an important topic in the induction programme for new directors. Boards need to be aware of other powerful stakeholder communication channels, including social media. Relations with the workforce. The board has ultimate responsibility for ensuring that workforce policies and practice are in line with the company's purpose and values and support the desired culture. The Remuneration Committee has a role in advising the board in respect of rewards, incentives, terms and conditions, and other related items. Gathering workforce views. Companies should consider including individuals engaged under contracts of service, agency workers and remote workers, regardless of their geographical location. Companies should be able to explain who they have included and why. Companies need to create an environment in which the workforce feels it is safe to raise concerns. It is critical to success that leaders actively listen and feed back how the matter raised has been considered, including any action taken. A commonly used tool for capturing workforce sentiment is the annual engagement survey. So how to engage with the workforce? A director appointed from the workforce, a formal workforce advisory panel, or a designated non-executive director. Division of responsibilities. The chair is pivotal in creating the conditions for overall board and individual director effectiveness, for setting clear expectations concerning the style and tone of board discussions, for ensuring the board has effective decision-making processes, and that it applies sufficient challenge to major proposals. It's up to the chair to make certain that all directors are aware of their responsibilities and to hold meetings with the non-executive directors without the executives present in order to facilitate a full and frank airing of views. The chair's role includes setting a board agenda primarily focused on strategy, performance, value creation, culture, stakeholders and accountability, and ensuring that issues relevant to these areas are reserved for board decision. The chair's role also includes shaping the culture in the boardroom, encouraging all board members to engage in board and committee meetings by drawing on their skills, experience and knowledge, and fostering relationships based on trust, mutual respect and open communication, both in and outside the boardroom, between the non-executive directors and the executive team. Also, developing a productive working relationship with the chief executive, providing support and advice while respecting executive responsibility, and providing guidance and mentoring to new directors as appropriate. Leading the annual board evaluation with support from the senior independent director as appropriate and acting on the results. Considering having regular externally facilitated board evaluations. The chair should ensure that adequate time is available for discussion of all agenda items, in particular strategic issues, and that debate is not truncated, and that there is a timely flow of accurate, high quality and clear information. The board determines the nature and extent of the significant risks the company is willing to embrace in the implementation of its strategy, and that all directors are aware of and able to discharge their statutory duties. Also, that the board listens to the views of shareholders, the workforce, customers and other key stakeholders. And that all directors receive a full, formal and tailored induction on joining the board. All directors continually update their skills, knowledge and familiarity with the company to fulfill their role both on the board and in committees. The chair should ensure that board committees are properly structured with appropriate terms of reference, which should be published on the company website. The terms of each committee should set out its responsibilities and the authority delegated to it by the board. The chair should ensure that committee membership is periodically refreshed and that individual independent non-executive directors are not overburdened when deciding the chairs and membership of committees. No one other than the committee chair and members is entitled to be present at a meeting, but others may attend at the invitation of the committee. The minutes of committee meetings should be circulated to all board members and the company secretary, unless exceptionally it would be inappropriate to do so. The remit of each committee and the processes of interaction between committees and between each committee and the board should be reviewed regularly, for example, during the board evaluation. The Senior Independent Director. The Senior Independent Director should act as a sounding board for the chair, providing them with support in the delivery of their objectives and leading the evaluation of the chair on behalf of other directors. The Senior Independent Director might also take responsibility for an orderly succession process for the chair, working closely with the nomination committee. It is a good idea for the Senior Independent Director to serve on committees of the board to improve their knowledge of company governance. The Senior Independent Director should also be available to shareholders if they have concerns that contact through the normal channels of Chair, Chief Executive or other Executive Directors has failed to resolve, or for which such contact is inappropriate. When the board or company is undergoing a period of stress, the Senior Independent Director's role becomes critically important. They're expected to work with the Chair and other directors and/or shareholders to resolve significant issues. Boards should ensure they have a clear understanding of when the Senior Independent Director might intervene in order to maintain board and company stability. The role of Executive Directors. Executive Directors have the same duties as other members of a unitary board. Executive Directors are likely to be able to broaden their understanding of their board responsibilities if they take up a non-executive director position on another board. The role of the Chief Executive. The Chief Executive is responsible for ensuring that management fulfills its obligation to provide board directors with accurate, timely and clear information in a form and of a quality and comprehensiveness that will enable it to discharge its duties. The necessary resources for developing and updating their knowledge and capabilities, appropriate knowledge of the company, including access to company operations and members of the workforce. The role of non-executive directors. Non-executive directors should, on appointment, devote time to a comprehensive, formal and tailored induction that should extend beyond the boardroom. They should devote time to developing and refreshing their knowledge and skills to ensure that they continue to make a positive contribution to the board and generate the respect of the other directors. It's important that non-executive directors do not operate exclusively within the confines of the boardroom, but have a good understanding of the business and its relationships with significant stakeholders. Compensation, succession and evaluation. The nomination committee is responsible for board recruitment and will conduct a continuous and proactive process of planning and assessment, taking into account the company's strategic priorities and the main trends and factors affecting the long-term success and future viability of the company. Developing a more diverse executive pipeline is vital to increasing the levels of diversity amongst those in senior positions. Diversity in the boardroom can have a positive effect on the quality of decision-making by reducing the risk of groupthink. With input from shareholders, boards need to decide which aspects of diversity are important in the context of the business and its needs. The needs of the company and the board will change over time, so it is wise to manage expectations and encourage non-executive directors to be flexible about term lengths and extensions. Putting the succession plan in writing can help ensure it is followed through. Succession plans can also help to increase diversity in the boardroom and build diversity in the executive pipeline. Succession plans should consider the following different time horizons: contingency planning, medium-term planning, and long-term planning. Length of service. Boards will need to justify why they consider a non-executive director to be independent beyond 9 years. For the chair, the 9-year period is calculated from when they were first appointed to the board. However, there may be reasons for justifying a limited extension to the term of the chair beyond 9 years if prior to becoming chair they have been a board member for a significant amount of time, and the appointment supports the company's succession plan and diversity policy. This paragraph has been inserted specifically to enable boards to promote female directors to chairmanship roles, even though they might already have served a significant time on the board. Evaluating performance. Boards continually need to monitor and improve their performance. The evaluation process should be objective and rigorous. The nature and extent of an external evaluator's contact with the board and individual directors are defining factors in quality, and questionnaire-based external evaluations are unlikely to get underneath the dynamics of the boardroom. The company should review how effective the board evaluation process has been and how well the outcomes have been acted upon. Audit, risk, and internal control. The Audit Committee. The Audit Committee is responsible for discharging governance responsibilities in respect of audit, risk, and internal control, and will report to the board as appropriate. Regular risk assessments and reviews of risk management systems, including information on close calls and near misses, will help the board determine whether the systems in place are robust enough to deal with a wide range of risks. Risks can emerge and crystallize rapidly. The systems in place to monitor risks should include procedures to elevate any concerns to the board's attention as quickly as possible. Processes for doing this and agreed triggers should be clear and be implemented quickly. Remuneration. The Remuneration Committee has delegated responsibility for designing and determining remuneration for the chair, executive directors, and the next level of senior management. It's vital that the Remuneration Committee recognises and manages potential conflicts of interest in this process. The Remuneration Committee is also tasked with reviewing workforce remuneration and related policies. The review is limited to workforce remuneration and related policies in respect of persons engaged under an employment contract, or a contract or other arrangement to do work or provide services personally. The review will include matters such as any pay principles applied across the company, base pay, benefits, and all incentives and aspects of financial and non-financial reward that drive behaviour regardless of where this is managed in the business. The design of remuneration policies, structures and schemes is a crucial part of the Remuneration Committee's role. Remuneration committees are expected to focus on the strategic rationale for executive pay and the links between remuneration, strategy and long-term sustainable success. It is important to avoid designing pay structures based solely on benchmarking to the market or the advice of remuneration consultants, as there is a risk this could encourage an upward ratcheting effect on executive pay. Where performance-based incentive plans are used, the choice of performance measures is important. Using a range of financial, non-financial and strategic measures can help ensure that targets are aligned with how the company will deliver value over the long term. Circumstances where it may be appropriate to exercise discretion include taking account of share price growth and currency fluctuations and the impact of a share repurchase scheme or a government support initiative. Any exercise of discretion should be clearly disclosed and explained. Schemes should also include malus and clawback provisions in certain specified circumstances. Such circumstances might include payments based on erroneous or misleading data, misconduct, misstatement of accounts, serious reputational damage, and corporate failure. Compensation commitments due to directors under their terms of appointment in the event of loss of office should be proportionate and variable by discretion, so that the Remuneration Committee can vary compensation where appropriate to the circumstances and to reflect departing directors' conduct and performance.